ladies and gentlemen. I am instructor Dr. J, and this is Entrepreneurial 101, and we are in Module 6, Entrepreneurial Finance. So, in this module, we're going to describe financing considerations for entrepreneurs and talk about the different advantages and disadvantages of debt financing and equity financing and the different types of financing available at the different stages of a startup. So we'll talk about, like I said, debt financing, equity financing, and personally financing your startup. Now, securing needed finance is one of the most important functions of a startup business, right? And you have to know what types of sources of financing you need at the various stages of venture capital. Because without funding, without money, you can't run your business. Right? Like cash is king in business. There's one thing you can take out of this course, one of this entrepreneur 101 course is cash is king, and you need money to run the business, right? One of the main reasons, or main reason why businesses fail, is because they don't have enough cash to continue the business in operations, let alone grow, right? So, and especially in a startup, you need money. You need to fundraise money one way or another, whether it's your own personal money, whether that's going to talk to an angel investor, whether it's going to business plan competitions, whatever it needs to do, you need to raise that money. And we're going to talk about some of the ways that you can fundraise money. So, and I'll also talk about my personal experiences with fundraising money. So, one of the first ways is like personally financing your startup, right? So, startup capital, some of the smallest ways that you can raise capital is your personal money, right? You can dip into your savings account, right? Let's say, for example, you have $10,000 or $15,000 uh, in your savings. You may want to grab $5,000 or $3,000 or whatever it may be to personally use your own money into your startup. And that's what a lot of people do that. I did that. I had some of my money in my savings, and I dipped into it, the little that I had, and I put it into my startup. And remember when I talked about in the other modules, being, having calculated risk. So you have to take a calculated risk in your venture, right? You're not going to dip into your entire savings and take it all and use it all for your startup because it may fail. Especially if you're married. If you're married, you're going to have to talk to your significant other and saying how much you can dip into yours as savings because your significant other may not be on board. But that's for another topic for another day. So personal money is one way to fundraise. Uh, Asking family and friends, that's another way that people do, but I would suggest that if you're going to do family and friends, you be very careful who you ask and you make sure you write a contract that, either this money is just going to give, it may be lost. It may be, you may never see a return on your investment. Or that person may just want to provide you a loan, which is a whole nother different thing. So you can ask family and friends. Another one is startup prize money. But I mean by that, there are organizations out there, and even also universities now who have business plan competitions. And I know Rice University, for example, in Texas, in the state of Texas, in the United States of America, they have a huge business plan competition, a yearly one. I believe they still have it. It's a huge amount of money. There's other big business plan competitions. I believe University of Michigan also has one. But a lot of universities, they have entrepreneurship programs, or in the College of Businesses, they have business plan competitions, which you may or may not be able to enter. You have to look into the details because some of them you have to be a student at the university, or one of the students had to be the majority owner of the company, whatever it may be. But you could look into that, and that's how uh, my first one of my first cracks at startups, we won a business plan competition. This was a 2012 Oklahoma State University Riata business plan competition. We won first place, so that was some startup capital into the business. The business is no longer open. And then the next year, I won the Best Social Venture Award in the 2013 Oklahoma State University Riata business plan competition, and that was about $1,000 in prize money that I won, which went all to my startup. So that was $1,000 that I had, right? So that was my startup money plus a little bit of savings that I had. And then, of course, I won about $300 in an elevator pitch competition there at Oklahoma State University that year. So that was another, $300, and I raised another 500 or so dollars um, online through GoFundMe.com through crowdfunding. So that was my startup money that I used for one of my startups. Oh yeah, it helped me. And again, and the great thing about startup money is there's really no strings attached, because it's like it's not a loan. It's not like the university takes ownership into the company. Well, of course, you have to look into the details about it. When you get the prize money, what are the strings attached to it? But the money that I raised, there was no strings attached. It's like here's your prize money, use it for your business, and that's it. And I will say that when you start up your business, make sure you start open up a business account at a different bank, and put that money in there, and so you won't mix your personal and your business money. Believe me, it's going to save you headaches, especially when you have to fill out taxes. But that's one thing I personally suggest. Get into go look into different business plan competitions that there are in your area, or around the country. So debt financing, right? There's another way that you can fundraise money, right? Debt financing, from an entrepreneur's perspective, the cost of debt financing is interest that they pay for the use of money that they borrow. And then from the investor's perspective, their reward or return on the debt financing is the interest that they gain in addition to the return of money that they lent to the entrepreneur or the borrower. So basically, it's like you get a loan of some sort, and it's debt that you have to pay off, and the person who gave you that loan is making money from the interest, right? Um, the good thing, the advantages of debt financing is that you're not sacrificing any ownership, right? You certainty of payments, right? You know what you're going to pay on your loan. Um, so that of course is the advantage of that. Yet another one, it is allows for trade on equity. What trade on equity is, it's basically a method to enhance the rate of return on common shareholders' equity by using debt to finance asset purchases, uh, or other measures that are expected to cost less than the earnings generated by the action taken. So that is, of course, the advantages of debt financing. The disadvantage, though, of course, is that you owe the money, right? You take out a loan, let's say for example 5 years, $20,000, a 6.5 interest rate. You got to make monthly payments of $500, and I'm just throwing out these numbers, right? You got to pay that money. It's a loan, you got to pay that money, right? Even if if the business fails, you still got to pay that money. So you owe money, and of course you may pledge collateral. Let's say for example you open a pizza shop, and the collateral was the equipment on that, right? And your business fails, guess what? There goes that collateral. So you have to take that into consideration. Debt financing, you gotta be very careful with it. Again, you have to take your calculated risk if you're gonna take out a loan. And just note that not everybody loans money to startups, right? Because you haven't proven yourself in the game. You probably haven't made much money. Talk is cheap. You have to prove it in order to get any type of debt financing. Equity financing, right? That's another way from an entrepreneur's perspective when it comes to equity financing. It's the cost of equity financing and the loss of some control over their venture as they must now share ownership of the business. From the investor's perspective, the reward in exchange for the purchasing an ownership interest in the business is the potential to share in the anticipated future success of the business by possibly receiving dividends, right? A portion of the profit that is distributed to owners, and by possibly being able to sell ownership interest to another investor to make money. So here's the thing about equity financing, right? In equity financing, it's an investor that comes into your business and says, I'm going to invest $100,000 or $1 million, but I want 30% or 40% or 51% of your company, right? So and there's different ways. We got angel investors, venture capitalists. We have public offerings. So the the good thing about equity financing, right? There's no need to pledge collateral, right? And you gain valued advisors, right? That's a good thing about when you have a venture capitalist or a angel investor, right? They're giving you not only money but advice on how to run the business, right? Here's the thing, the downside to equity financing when you have an angel investor and when you have a venture capitalist, right? It's very difficult to obtain money from a venture capitalist. Not everybody gets money from a VC or an angel investor, right? So again, it's extremely difficult to obtain money. It's not an easy thing. You may talk to 200 investors and none of them will give you money. You know, I mean, you see it on the show Shark Tank on ABC. You know, those guys, those are investors. They usually don't give to everybody that goes on that show, right? They're very particular where they invest. They very particularly who they want running the company, and you give up ownership. It may be that you get an investor into your business, and guess what? They'll be like, you know what? You're not running the company how it should be. You're fired. You're gone, and they bring in their own people. And that happens, guys. You have to be very careful that if you're going to bring in investors, just note that if you're not running the company how they see it, they're either going to pull their money out or they're going to take over the company and fire you. And that sucks for somebody who, you start up this company, you think it's going to be great, and then all of a sudden you suck at running the business how they see fit, and you're gone, or they pull their money. So either way, which one you want? You want me to pull out the money, or you want you're gone? Which one you want, right? Go back a little bit about the difference between venture capital and angel investors. A venture capital money or a venture capitalist is a group of individuals an individual who pulls in, raises a pool of money, and they're very particular who they invest in. They only invest in high growth companies, right? Uh, they're look like venture capitalist companies. You know, are not going to wait 10 years for your company to make money, right? They want in 5 years or less, we want to make 300% of our investment back. They're looking for the next Facebook, the next Twitter, the next YouTube, right? They're looking for those high growth companies, right? They're not going to wait 10 years to only make $1 million. They want to make hundreds of millions and millions of dollars on their investment. Um, Again, then they may take over your company, and to get venture capital money is extremely difficult. An angel investor, on the other hand, is usually a wealthy individual, not very well known, who invests in your company, and they may take interest in your company by providing a loan or providing some money. They're less restricted on their investment and how they're going to use their money. But of course, it's a very rigorous process as to if I'm going to invest in your company or not. Of course, there's different financing stages or phases in the company, right? The idea development phase or the initial starting phase. You're going to use your own personal money. When you're at the very start, people are very wary if they're going to invest in your company. So you're not going to get that much investment in your company at the idea and of course the startup phase, right? Angel investors, they may put at the startup phase, not usually. Now, customers this is another way. Customers can be another way of financing your business, right? They may place How customers can do that is they can place orders for services or products that pay them up front. Uh, you know, for example, like if you put up a website, like say for example your startup is t-shirts, right? You're gonna sell t-shirts and sweaters and all that. And you price your t-shirts at 20 bucks and your sweatshirts at 30 or I mean $50. And you say, all right, pay for this up front and you'll get your t-shirt or your sweater in 6 weeks, 6 to 8 weeks for delivery. That will give you capital, that will give you money to produce those t-shirts, right? You have a 6 to 8 week period of when you will produce that. So that's one way you can do it. You can have the customer actually pay you up front. It doesn't work all the time. It can work. It's just you gotta test out the market and see if people are willing to put in money up first. Uh, you know, so again, it may or may not work. You may get some venture capital money at the startup phase, but again, it's not that common. So if you're in the startup phase, venture capitalists ain't gonna look unless they see something like, oh my gosh, this is the next Facebook, this is this next Twitter, the next YouTube. We gotta invest now and take advantage of it. But again, it doesn't happen all the time, right? Early operations, right? That's where you may get some venture capitalists. So you may get those venture capitalists at the growth phase. Again, VCs may come in. That's when you're starting to you're gaining money. You're quickly expanding. You're quickly growing. You need more money to grow. So you get more venture capital money at the growth phase, and then of course the exit or the harvest phase when either you're going to be a company for a long time like Facebook, or you're going to sell it. You're going to exit out of it. You may do an initial public offering, which is what usually at the harvest phase, an IPO, which is usually called an IPO. Have you ever heard of that? An IPO is issuing common stock or shares to the public, used by companies seeking capital to expand. So when you hear these IPOs, that's the initial public offering. Is like the company is asking for the public to give it. Hey, we need more financing to run our business, so we're gonna sell stock in our company. You can buy shares, and you can and of course it's a very vigorous process because you have to price the stock at the sort of the right price, because if you make it too small, right, it could affect your company, or if you make it too big, nobody's gonna want to buy it. So you again, that's why you have professionals at this stage. You have professionals who do this kind of stuff. Or you can have a buyout, right? Some other company can buy you out, right? Usually at year five, companies can be like, all right, we're going to buy you out. And usually big companies buy little ones. Like, for example, when I was at a biotech startup, the one that we won the business plan competition in 2012, our projection was in 5 years we're going to get bought out by a major company in the game that we were in, the industry that we were in. That was our buyout. And we valued ourselves at a certain amount of money. We're gonna get bought out, and that's what usually happens in startups. And that doesn't happen all the time, but usually you get buyout or IPO. And an IPO is extremely difficult. It doesn't happen to every single startup that goes in there. So don't be don't think that everybody's gonna get an IPO offering. So that is the different phases of financing. Again, every single one has a different stage. So that was module 6, entrepreneurial finance, and I'll see you guys in the next one in module 7, where we'll talk about business setup, startup, and growth.